Okay, hi everyone. This is going to be the second video for the PowerPoint for chapter 6. So kind of picking it up from the last video, I think we ended somewhere around 61. We'll start here with 62, right? And if you remember from the previous video, we looked at a situation where there was kind of a package deal, right? There was like the Xbox, flying all over the screen here, in the Xbox Live, right? We had the total cost of like $250, and then we had to allocate that price based off of what it was we were giving, right? In order to do that, right, to allocate, we had to look at the standalone prices, right? In other words, like what you sold the Xbox for by itself divided by what you sold the Xbox for plus the Xbox Live by itself, right? So you can reference the first video for that, right? So maybe of the 250, we use the standalone price to figure out the percentage, and maybe it's like, $250, right? The Xbox, you would recognize that. Now, at a point in time, here you go, here's the Xbox. In the Xbox Live, you would recognize over a period of time, right, as you kind of provide that service. That's great, right? So one of the things the book talks about here is sometimes you don't know the standalone price, right? When you're trying to figure out that percentage. Maybe it's a new product, right? We've never offered Xbox Live before. Well, what they do is they kind of give you a proxy, right? Three alternatives you can use when you don't have a standalone price, right? So one is the market, right? You can look to see what this would go for if it was sold in the market. Oh, Nintendo charges $60 a year. Well, ours would probably go for $60 a year. Alternatively, we could figure out a standalone price, a proxy, if we would do cost plus a profit margin, right? Maybe this Xbox Live, in order to provide this for a year, it's going to cost us $40, right? And we'll add on top of that a 20% profit margin to figure out what our standalone price is. Finally, here under the residual approach, this is essentially saying, hey, we know in this situation like two of the three, right? In other words, if we have two of the three variables, we can back into or solve for the missing variable for the standalone price, right? So let's look at an example here showing that residual price approach, right? So we know we sell the package for $250, right? When we run the numbers on it, right, we get our percentages over here. We have a standalone price of $240 for the Xbox, right? So if we have $250 and we know $240, then we can say, hey, we will do an estimated for the Live of 10, right? So it's like we have these two variables, and then we can back into the missing one, residually, whatever the leftover is, 250 minus 240, the leftover 10, that's going to be the item there. And in this way, right, you would do the journal entry for the sale for total. You would recognize the Xbox portion now, right, at a point in time, and then the Live would be deferred or unearned revenue, right, that you would recognize next period, right, over a period of time as you earn it. All right, then they have some sort of nuanced situations here for it. So this is in step 5, figuring out the performance obligation. Right, let's talk about these. We'll start with a license, right? This is normally associated with intellectual property, right? We own this intellectual property, and we are going to let you, the customer, use it, right? We own a song, right? The media, we're going to let you use it in your movie, right? We will give you a license to use it. How you treat and when you recognize a revenue for a license really depends on the underlying intellectual property. In other words, if it's functional intellectual property, you're going to recognize it at a point in time. If it's symbolic intellectual property, you're going to recognize it over a period of time. So let's talk about, what are these, right? We're looking at the underlying IP. Functional intellectual property is when it has a significant standalone functionality. What we do isn't going to really affect the seller's usage of it, and we're transferring a right of use, right? So for example, a music download would be functional IP. Whenever we sell that or we license it there, we will recognize that revenue at a point in time. Most software, assuming we aren't kind of continuing to update it, if it's just here you go, we sell the software, that would probably also be functional IP. In distinction, right, so we said functional IP is at a point in time. We also have symbolic IP, right, where we're going to recognize that over a period of time, right? So in this case, it lacks significant standalone functionality. What we do will affect the ability and usage of the person we're selling it to, and we're transferring a right of access, right? So what are some examples here, right? Trademarks, logos, brand names. So what would be an example of this, right? So maybe we're Disney, right? And we're licensing Mickey Mouse, right? A trademark or a logo of him for a customer who wants to put it on T-shirts, right? Maybe it's for a 6-month period, right? The idea with this is because it's the right type of IP, and we're transferring a right of access, and what we do can affect their usage, right? If Disney has like a big lawsuit against them, that's going to affect this guy's ability to use it. We have, in this case, symbolic IP. Accordingly, we will recognize the revenue over that 6-month window kind of periodically as we earn it, not upfront whenever we make the original sale. Okay, you can look down here. This is going to be an exception for stuff like virus software. Generally, software is going to be functional, but it can be symbolic. You have to kind of look at the substance of it. All right, franchises, right? So this normally has a franchisor. We can think of that as like corporate McDonald's, and then it has a franchisee, right? Like somebody who wants to open up their own McDonald's, right? So if you walk into McDonald's, it's either corporate owned or it's franchisee owned. What happens here is, all right, we're looking from corporate's point of view. This guy comes up and says, look, we're going to give you $1 million to let us open up our own McDonald's. And what we will do, corporate, right, we will give you some IP, right? You get to use our little McDonald's logo, and we will give you property, right? Maybe we're going to sell you the ovens, we're going to sell you the fryer, right? All that stuff. The idea with this is when we're McDonald's, we don't recognize the revenue like $1 million as soon as we get it, right? We kind of have to look underneath. What does that 1 million, right? What are we giving him, right? So if it's IP, right, a portion of that might be the IP. We have to follow the IP rules. If a portion of that's property, right, it's going to be whenever we transfer that property to him. So it's kind of looking at the substance of what's going on, not just the flat fee in that case. How about these bill and hold arrangements? What's going on here? Another kind of nuance with it. Well, the idea with this is the customer comes in and says, look, I will pay you, I will buy it now, but I'm not actually going to pick this car up, right? Whatever it is we're selling for 6 months. Can you please hold this for me until I pick it up, right? So from, let's just say it was a Ford, right, or any type of company, when should they recognize the revenue in this situation? Well, the general rule is going to be you only recognize the revenue whenever you deliver the goods to the customer. So if you bill them up front or they pay you up front, and they're not going to get it until later, unless and until you transfer control of that, only then do you recognize the revenue. They have some things here with COVID. You can read about that. How about consignment? arrangements. What's going on here, right? So you're going to have a cosignor, right? You're going to have a cosignee, right? We'll just say a pawn shop, and then we'll have a customer, right? We'll make the customer, a female there. All right, so customer, cosignor, cosignee. What's going on? And it's not always a pawn shop, right? I just use this as the sake of example to help you understand it. Imagine we have a guitar, right? Or any type of like inventory we're selling, right? We give it to an intermediary, right? Like here, pawn shop, right? Can you sell it for us? Later on, they may find a customer and they're going to take a cut of it, right? So if they sell it for $100, they may take $20, right? The question becomes, when do we, from our point of view, the cosignor, right? And it might be OR instead of ER, but whatever the case is, when do we credit revenue for this? Is it whenever we give it to the pawn shop? No, right? We wait until the sale, right? Unless and until that intermediary, the cosignee, sells it, then we recognize the revenue. All right, let's talk a little bit about gift cards, right? We're just plugging along here. There's a lot of information on it. When we get a gift card, right, if you think about it, you get the money before you provide the service, right? Say we're a pizza company, we sell gift cards, right? We know when you get that money up front, it's going to be unearned revenue, deferred revenue. Later on, right, whenever they come in and they use the gift card, right, that's when we're going to credit revenue for it. It's not when we get the money, it's whenever they use the gift card. We provide the services, we give them the goods. In this framework, right, whenever we credit revenue, it's really for one of two things. Whenever they use it, right, they use the gift cards, or, right, or really, if basically the gift cards expire, right, or we have some reason to believe that the customer, prior gift cards we sold, it's a remote chance that they're going to utilize it, right? So then we can just basically say, okay, we can recognize the revenue, right? Those gift cards are nothing there. So here's an example, right? It looks like during the period, people came in and used 5.4 of gift cards, and then 450 expired, right? I'll just say, we knew that 450 expired. How much revenue do we credit for the period, right? What's going to be the combo of those two things? You add them together there. All right, we've been talking about revenue, right? Obviously, that's linked up to the financial statements. You're going to have appropriate footnotes on there. You'll also see things related to the balance sheet, right? So we were talking about unearned revenue, right? Where you get the money before you provide the service, right? In that situation, right, where you have unearned right, revenue, that's a liability, right? That's going to be considered another way of saying a contract liability. On the flip side, right, if you give the services before you get the money, that's either going to be a contract asset or an account receivable. What's the difference between them? Well, if the only thing that triggers, right, getting the money is the pure passage of time, it's an account receivable. If some other event or condition or item triggers getting the money, we can call that a contract asset. All right, so we looked at all of this in the first video and in this video, right? Step one, identify the contract, right? We looked at that scenario where it was illusory, right? Either party could do what they wanted, right? Well, that wasn't the contract then, whenever it happened, right? We need to make sure that we meet all of these rules. We looked at the performance obligations, right? We said you need to basically find things that are capable of being distinct and separately identifiable, right? The Xbox with the live, right? That's pretty easy going there. Some things that aren't separate are built-in warranties, or if they give us the cash up front, right? Prepayments. However, if we have extended warranties, or we basically provide a material right, then that will create a separate thing we have to attract, right? So there, remember we did that coupon example, right? Where we had to break out between the Xbox and the coupon. That ended up becoming a separate thing we had to track on there. Step 3, determine the transaction price, right? Most of the time it's given, but there can be variable consideration, right? We looked at that example. I can't remember the exact numbers, but it was like, look, we get 300K up front plus 180K bonus, right? Well, that bonus was contingent, right? It was like an if-then type thing. In that situation, right, where you have this variable consideration, it's variable. You could get it, you couldn't get it. There's two ways to account for it: the expected value or the most likely amount. On top of all of this, right, we have this constraint that says, look, it's got to be probable that this is going to happen, right? If there's anything like kind of fishy here, we don't think we're going to get it, then you don't account for that. Likewise, we talked a little bit about a principal and an agent, right, where they're going to get like their cut, the agent, we send them over to Germany to sell that iPad. We talked about a financing component, right, when it's basically a year or more on there. The payments from the seller to the customer, you can read that. I'm not going to test you on that guy there. Step 4, right, we talked about allocating the transaction price, right? We said you're going to look at those standalone prices, right, to help give you the percentage that you allocate from the package deal, right? If you don't have a standalone price, right, we kind of have these proxies that come into play that can help you. You can look what it would go for on the market. You could use cost plus a profit margin. You could back into it if you know 2 of the 3 variables. And then we talked a little bit about, in an overall way, right, you can recognize revenue at a point in time or over a period of time, right? There's kind of different criteria that come into play for each of those. Right, that's an or there. And then we talked about specific setups, right, with licenses, kind of functional versus symbolic licenses. Franchises, right? You need to separate what it is you're selling, the goods and services versus potentially the IP. Bill and hold arrangements, right? You don't recognize the revenue until you deliver the goods. Co-assignment arrangements, right? You don't recognize the revenue until that middleman sells the goods. Gift cards, right? You don't recognize the revenue until 1, they cash in the gift cards, or 2, the likelihood of them cashing them in become remote, i.e. they expire on there. Okay. Now we're going to get into, and this is where it gets messy. So this is like something you're probably going to want to listen to, once or twice. You're not going to hear it once and get it automatically. But let's talk about revenue from long-term contracts, right? Maybe you hire us to, over the next 3 years, right, build a building for you. The question becomes, how do we account for this, right? When are we going to recognize the revenue? Throughout or at the end, right? Like, how do you kind of do this? Well, as a starting point, we're going to treat that building as a single performance obligation, right? And in that way, right, for purposes of step 5, kind of continuing here, there's 2 approaches we can take, right? We can recognize the revenue over time under something called the percentage completion method, or we can recognize the revenue upon completion right, whenever we're done, under something called the completed contract, K for contract, right? So we can recognize the revenue over time or at the end of the contract there with it. So let's look at an example here for it. They're giving us a lot of facts. It's not, like I said, it's going to be a little bit overwhelming. One way I would approach this is this, right? We have two methods, right? Percentage completion, that's method one. We have completed contract is method two, right? One is throughout, we're going to recognize revenue. One is at the end. In this way, right, we're going to have 5 journal entries, right? 1, 2, 3, 4, 5, right? 1, 2, 3, and 5 are going to be the same between them. 4 is going to be different. And with 4, right, I'm going to just write it out. We'll come to it. It's going to be generally debit something called CIP, construction in progress, debit construction expense, and credit revenue, right? That journal entry 4, if it's under percentage completion, you'll make it hypothetically at the end of each year. If it's completed contract, you'll only make it once at the end. So the journal entry itself, that debit and credits are the same, but the numbers that go in there and when, how often you make that is going to differ. Okay, so that's the framework. Let's look at the numbers here. Right, we have a contract where we're going to build an office building for $5 million. Right, they then give us a bunch of information here. It looks like it's going to take 3 years, 2024, 2025, and 2026. We know at the end of 2026, the entire thing cost us $4.1 million, right? So we're going to have a gross profit here of 900 grand, okay? Now, one thing to be aware of before we start looking in the specific numbers on this is whenever you do a long-term contract problem, always keep your years separate, right? Look at it 1 year at a time. If you start looking at stuff cumulatively and not taking it bit by bit, it will overwhelm you, right? So 1 year, we're going to kind of have the eyeball on that. 1 year, we're going to have the eyeball there. 1 year, right? Take it one step at a time. And really what we're going to do is, at least for the percentage completion, we're going to run a little schedule to tell us what numbers to put in this journal entry. But if we look at the information they gave us, right, it's 3 years. They tell us what were our costs incurred during the year, what was from prior years, what's the total of those two things, right? What's our cumulative cost to date? What do we think it's going to cost us in the future at the end of the year, right? So the eyeball here is when we look at 2.2 here, that means at the end of 2024, that's what we think it's going to cost. You can see it changes from year to year. It's not, right? When you're doing something, estimates change, things change. So then that will get you your total estimated and actual. So what we put into it at the end of that year plus at the end of that year, what we think it's going to cost us. We have our billings and we have our cash collections that we made, right? They give you all of this. How do you deal with it? Well, the first thing is, right, we said there's 5 journal entries, right? 1, 2, and 3 are going to be the same, right, under either method, right? So we got journal entry 1, journal entry 2, journal entry 3. And this is really just taking the information from over here and plugging it in, right? So we look at journal entry 1, we need to record the construction costs, right? We're going to debit construction in progress, credit the cash. And when you think of construction in progress, it's really going to be a WIP account that we build up, right? We keep building it up, building it up. And then it will also be comprised of the gross profit that we earn on this job, right? So that's the idea there, to record the construction costs. Where did we get those numbers? We grabbed them right from the facts from the prior slide. Then to record the progress billings, debit AR, credit billings. One thing here is these accounts are related. And what I mean by that is billings is a contra account to construction in progress, right? So that's going to be an asset and a contra account. We will see eventually you put those on the balance sheet. And then journal entry 3, right? Debit cash, credit accounts receivable for collections, right? This isn't that hard. It's just memorization. If you can take numbers and put them into journal entries, you can do journal entry 1, 2, and 3, okay? Then, right, now we're going to look at journal entry 4, right? We said this one is different. We know the journal entry is going to generally be debit construction in progress, debit construction expense, credit revenue, right? But it depends, right? Do we do that each year or do we do that at the end, right? We have those two, percentage of completion versus completed contract. Now, if we look at this high level, right, if we have up here percentage, or I'm sorry, this is completed contract up here, right, completed contract. Here we are at the end, and we do our journal entry, right, debit construction in progress, right? Remember we said that represents a WIP account plus the gross profit. Debit cost of construction 4.1, credit revenue 5. Right? This is, again, we get these numbers right from the schedule in the sense that 5 million, right? 4.1. And then you can plug the CIP if you want, right? But it's always better to understand what it is, what it actually is. Here it's representing the gross profit. If it was a loss, we will see this journal entry 4 can be modified. You can have a credit to CIP if it's a loss, okay? So there's the idea journal entry 4 for completed contract. How do we do it for percentage completion, right? Well, every year we're going to do the journal entry, right? For year 1, year 2, year 3. And you can see, right, that the combo of all the revenue is going to equal 5 million, right? The combo of all those is going to equal 4.1. The combo of all those CIPs is going to equal 900,000. Instead of doing it all at once, we kind of spread it out over time, okay? So if we look at this, right, we will now kind of unpack and say, how do we get those numbers, right? We know hypothetically it's over time versus at a point in time. We know the journal entry. We said for completed contract, you can just plug it in, right? Based off your revenues, expenses, hit CIP for the difference. And in this way, right, we said CIP is really comprised of, where you're going to see that is journal entries 1 and journal entry 4, right? It's generally going to be debits in each of those cases. And in journal entry 1, right, what we're doing here is we're building up that CIP kind of like a WIP account. And in journal entry 4, right, that's where we're recognizing the gross profit on it, Okay, essentially what we do here is we build up this CIP account, and then, right, so that's kind of journal entries 1 and 4. And then in journal entry, what was that? I think that was journal entry 2, we did the billings, right? Right, so we build that up as well, right? The idea is we're building up each of these accounts. Remember, they're related to each other. One is a contra account. What we ultimately do in journal entry 5, like we'll see, and remember, this is the same for each of them, is we built these up. Now we got to kill these accounts, right? So we're going to do debit billings, credit CIP for the 5. Right, journal entry 5 is really just get it off the books, right? For there, okay? So that was kind of looking at completed contract, right? You look at the end, you plug the information into the journal entry, and then you would kind of get it off the books. How about this percentage completion, right? We know it's throughout time. We know these are the numbers. How did we get what goes in revenue, right? Well, what we're going to do here is a little bit of a formula, right? So you can use that formula. How I like to think of it is to kind of break it down in a couple steps, just be mechanical, right? So the first thing is I'm going to figure out the contract price. The second thing is I'm going to take the cost to date over the total estimated cost, right? I'm going to put a little eyeball here because, right, you need to look at this. Sorry, that's not, it's more like a spider with 2 eyes, right? You need to look at this on a per year basis. Step 3 is going to be taking step 1 times step 2, and then step 4 is going to be taking step 3 minus any previous revenue that we recognized, right? That will tell you right here when you do this, what you put in credit revenue right here, and right here, right? Whenever you do that, then you can back into the rest of journal entry 4 with some of the numbers, right? So let's look at this 4-step process kind of illustrated, right? Remember we said with the eyeball, you got to do it per year. Right, so let's start here with 2024. It looks messy. It's not that bad if we kind of graph that on, right? So we're going to start here with the contract price, right? That's number 1, 5 million. They gave that to us. Then we're going to have 2, right? We're going to have cost to date over total estimated cost, right? And this is measured per year 1, right? So in this way, right, we put 1.5 in. We expect our total estimated costs to be the 1.5 we put in plus 2.2 that we still got to do, right? Then we're going to do step 3 where we multiply step 1 times step 2, right? So we're at step 3 right now for that. That was for 2024. Let's do it for 2025 just to show that it changes. Right, we have the contract price, 5 million, not too hard. We have our cost to date over our total estimated cost. This changed from last year, right? It was 1.5, now it's 2.5, right? Our cost to date in year 2 from the eyeball perspective or the million up here that we had during the year plus prior year's cost. Up until now, we put 2.5 into this. We expect an additional 1.5, right, getting us to the 4, right? So then we have 62.5. We take 1 times 2. That's going to get us our placeholder for step 3, okay? So these were our placeholders, right? We were on step 3 here. Then what we do is, right, we take step 3 minus any revenue we previously recognized. Well, in year 1, right, we didn't have any revenue we recognized. Accordingly, it's going to be $2 million that we credit for revenue. How about for year 2, right? Will be the 3.125, step 3, and then we take what we recognized before, right? The 2 million from before comes down, right? That kind of pattern, right? This is a schedule. You can see it's just the schedule, it's math, you repeat itself. We take the 3 minus the 2, right? That's how we get the credit here, right? Once you get the credit in the journal entry, right? If we were just focusing on 2024, right? We calculated the credit, right? We're on journal entry 4 here. You get the credit through calculating it. You can get the cost of construction, the 1.5, from the facts. And then we can plug the CIP, right? The idea with this is the CIP, that's going to be the gross profit, right? We have 900 for the whole shooting match. We break that out between 50, 125, and 275 on there, right? So, and then if we look at year 2, right, we calculated the 125. That million, where did we get that million from? If we go back up here, right, we have, a million up here, right? So you're gonna use that top number, 1.5 million, right? You can see where you get that from, million, 1.6, and then we plug the CIP. We plug the CIP, right? So this is showing, hey, that CIP, it can be a plug, right? You're wondering, where did we get that, right? Well, it's a plug to help, represent, that item. Or you can think of it like your gross profit, right? The 500, the 125, the 275. That's the 900 for the entire contract there, broken out, kind of pro rata on there. Then we have journal entry 5, right? We talked about this. This is the same for each of them. We got to get it off the books, right? So we're going to debit billings. We're going to credit construction in progress on there. This is just saying, hey, on the balance sheet, right, you have to have in that billings and construction in progress, the contra account, the underlying and the contra account. If the costs exceed the billings, right, we're going to have it on there as an asset. If it's the reverse, the billings exceed the cost, that's going to be a contract liability on there. So it's just showing you, hey, how does this shake out on the balance sheet throughout? They give us some problems, right? A lot of these, what they're looking at here are costs to date over total estimated costs, right? So here they're looking at 2025, right? Cost to date are the 3 and the 500, right? That's what we're into it today. Our total estimated costs are going to be what we're into it today plus what we think we're in the future for, 6.5, right? You just do the items here, right? That gives you the percentage on it. So there's kind of some variations with that, with the percentage. Then they look here, they build upon that, right? And they're saying, can you do like step 2, step 3, step 4, right? So we got the percentage, right? The cost to date. We multiply that times the contract price, right? The cost to date over total estimated cost. And because this was in year 1, right? They're looking at 2024, right? We don't have anything prior that we got to back out. So the calculated number there 4 will be what we calculate. Whereas here in year 5, right? 2025, there is 4 million that we got to back out from before. So it's kind of showing you the whole build out and the showing there of steps 1 through 4 for that percentage completion, for figuring out the numbers that go in there. Finally here, how do you deal with losses, right, on long-term contracts? Well, it depends. Is this a periodic loss where in one period we may be at a loss, but overall for the whole project we're ahead? Or is this an overall loss where we're kind of at a loser here for the project, right? Overall, are we good, but just for one period, are we kind of hitting a speed bump? Or is this entire thing kind of a loser, right? So if we look at this, right, this is just showing, if there's a loss in a particular period, right? In this case, when you run the numbers under percentage completion, you would see that during year 2, we're at a loss for that period, but overall, we're still profitable for the entire thing, right? In that situation, you just do the journal entry, right? You get to credit the revenue as you calculate. But in this case, right, for purposes of journal entry 4, you're going to credit the construction in progress, right, instead of debiting it on there. That's saying for percentage completion. For the completed contract, right, if you have that little blip, the little loss, you don't do anything, right? You just wait until the end and you recognize the revenue for it at that point in time, right? So that's kind of the situation when you have the blip, right, where you have that like periodic loss, but the whole thing's still profitable. How about if the entire thing is a loser, right? Well, we have percentage completion versus completed contract. Both of them, right, you can see we're at an overall negative loss there. How do we kind of account for this? Because they're telling us, hey, here in year 2, we find out that our costs are going to exceed our revenue, right? So we're at $100,000 loss in year 2. And then in year 3, like insult to injury, there's an additional 100 grand we're going to lose, right? So there's like, year 2, year 3. How do we do this? Right? So essentially what's going on here, right, if we're looking at recognized overtime, you just run the numbers, right? You run the numbers, you use that formula on it. You can see, right, at a high level, what's going on is year 1, we're profitable. That's great. Year 2, right, so year 1, we're profitable. That's great. Year 2, we're at a loss of 600,000 when we run the numbers on it, right? That was year 2, we were at a loss. And then year 3, right, we were at a loss as well whenever you run it. When you combine all of those things, right, the 500 smiley with the negatives here, the frownies, that's going to get you to the overall 200 that you lost, right? It's just piecemealing it throughout. Whenever we have, and that's kind of showing you here, right, year 1 and then year 2 on there for it. Oh, I'm sorry, it's year 2 and year 3, not a big deal. Year 1, we were profitable. If we go back there, right, so it's like profitable, loss, loss, profitable, loss, loss. How do you deal with this? The journal entries for year 2 and year 3. It's still that same journal entry 4, but it's just like we showed, right? You credit construction in progress. It will probably, right, you can get it as a plug, or you can think of it like the percentage of the loss each year, right, that goes in there for it. How we deal with the completed contract, this is where there's a little bit difference here, right? Because up until now, we've just waited until the end to take the revenue. That isn't necessarily the case for losses, right? Whenever you have completed contract and we have sort of this overall loss, you can, in this case, recognize it in the period, right, it incurs, right? So year 2, you would recognize 100,000. That's when it occurred. Year 3, the remaining 100,000 on it, right? That would be the CIP there for how it kind of breaks out in that case. And then that ends up netting to a loss. So a lot to take in, right? It's not something you're going to hear once. I would think of it the best way, at least for the contracts, is hey, we have 2 types. We have percentage completion, we have completed contract, a period of time versus a point in time. In that way, we have 5 journal entries. 1, 2, 3, 4, 5. All of them are the same except journal entry 4. Journal entry 4, if it's completed contract, we just do it at the very end. We look at the numbers, we plug it in. If it's percentage of completion, we do it at the end of each year with that little math formula, right? We find the contract price. We take the total estimated cost, the cost to date over the total estimated cost, multiply them together, right? Step 1, step 2, that would be step 3. And then finally in step 4, we back out from step 3 any previous revenue that we recognize. So with that, I'm going to end the video here.